Hey there, financial enthusiasts! Today, we're diving into the world of making money work for you with Warren Buffett's best dividend investing strategy for 2023. This strategy, shared by the legendary investor himself, helps you grow your wealth steadily by investing in certain types of stocks. We'll break it down step by step, so it's easy to understand and put into practice. Warren Buffett's Berkshire Hathaway has amassed an astonishing $100 billion in dividends since 1965, surpassing the total value of numerous Fortune 500 giants. Warren Buffett has also enriched both himself and his investors through dividend-paying stocks. This approach to dividend investing is widely embraced for its simplicity and potential to augment your income with minimal effort. Furthermore, it's accessible even if you have limited initial capital, making it an appealing option for those aiming to build wealth over time. But before dividend stocks, we need to understand two types of income: active and passive. Active income is the money you earn through hard work, like your job. Passive income, on the other hand, is money your money earns for you. The trick here is to use your active income to build your passive income. Here you set aside a small portion of your paycheck every 2 weeks and put it into, you guessed it, stocks that pay dividends. Now, some of you might be thinking about real estate. While it's true that real estate can generate nice passive income and increase in value, but it often requires a lot of upfront money to get started. In contrast with dividends, you can begin with as little as $100 or even less. Let's take Coca-Cola as an example. Warren Buffett is a big fan of this company and owns a significant number of shares. When a company like this has extra cash, it has three choices: save it for tough times, reinvest it in the business, or give it to the people who own shares, which are the shareholders. Since Coca-Cola is so well established, using the money for anything other than giving it to its shareholders doesn't make much sense. Coca-Cola has a history of paying dividends for a long time. Currently, it pays about 3.04% of its value to shareholders each year in dividends. These dividends are usually handed out every 3 months, which means you get a paycheck from them 4 times a year, which is nice. But how much will you get if you have just one share of Coca-Cola? Right now, if you own one share, you'll receive $1.84 over the course of a year. That might not sound like much, but what if you have 10 shares? Now you're looking at $18.40 annually. And if you're holding on to $1,000 worth of shares, you'll get $1,840 a year. To make $3,300 each month from dividends, you'd need to have a total of $1.295 million invested. But the best part is that there are some big advantages to owning stock. First of all, companies don't stay the same, and a good company like Coca-Cola tends to increase in value over time. As a company grows, the money you've invested in it grows too, and your dividend payments grow along with it. For instance, back in 2013, Coca-Cola was paying only 28 cents per share in dividends. But now it's up to 46 cents, which is almost double. And that's not even mentioning the fact that the share price has gone up by 60% since 2013. You might be thinking that the best way to make this work is to find stocks that pay the highest dividends, right? Well, that's not necessarily the smartest choice. Of course, you want to get the most bang for your buck, but it's crucial to do it the right way. The real test for whether a company should pay dividends is if it can keep creating more value than what it holds on to. While those high dividend yields might look incredibly tempting, more often than not, these sky-high yields can't be maintained by companies. In many cases, these companies are on the brink of financial disaster. Imagine you've invested a substantial amount in a company with a sky-high dividend yield of 10%. You're happily collecting those big payouts, but down the road, the company crumbles due to poor financial decisions. It's not your fault, but you end up losing all your money. The takeaway here is that while high dividends might appear attractive at first glance, they often hide underlying issues that companies don't want to reveal. You see, Buffett invests in a mix of different types of stocks, like banks, technology, and health-related companies. What catches his eye the most are companies that have something special going for them, like a famous name, a bunch of patents, or a big group of loyal customers. Before putting his money into a company, Buffett really does his homework. He reads those big yearly reports, listens in on those money talks companies have, and even sits down with the people running the company. He's also on the lookout for companies that are selling for less than they're worth. Also, Buffett doesn't rush things. He thinks the best way to grow your wealth through dividends is to buy a stock and hold on to it for a super long time. In fact, he's been hanging on to some of his stocks for decades. So, understanding dividends can be more complex than it initially appears. Nevertheless, if you like the content you are watching, comment the word "more" so I'll notice. But what if you're not into all the stock market fuss and want something easier? There's a solution for you too. ETFs, or exchange-traded funds. ETFs are like a bundle of stocks that are sold as one package deal. There are all kinds of ETFs out there, but I'll talk about two right now. One is called VYM, and it mostly looks at companies that give out nice dividends. Right now, it's handing out dividends that make up about 4.53% of what you invest, so you'd need around $875,000 to hit that $40,000 a year goal. Another choice is FDV, and it's giving dividends worth about 3.86%, so you'd need around $1,035,000 to get your $40,000 a year. Even though the ETFs are a bit easier, it's still a good idea to spend a moment and do a quick Google search on the companies they're made up of. This will give you a sense of what you're getting into. There's another choice for all you investors out there, especially those eyeing real estate. You can put your money into REITs, or real estate investment trusts. REITs are a lot like stocks because you can buy and sell them on the stock market, and they're companies too. But there are some big differences. First, these companies only deal with real estate. So it's kind of like getting a piece of the real estate action without owning property directly. Second, they're legally required to share a whopping 90% of their profits with people like you, which means big dividend payouts. Some good REITs to check out are XLRE, which is paying dividends at a rate of 7.44%. So if you're aiming for $40,000 a year, you'd need about $520,000 in the game. Another option is iShares, Cohen, and Steers REIT ETF, which is currently dishing out dividends at a rate of 5.86%. This means you'd need around $665,000 to pocket $3,300 each month. You might be wondering how to grow your money to $500,000 or more, right? I did say it's possible, so let me show you how. Let's stick with Coca-Cola as our example. I mentioned they're currently paying out dividends at a rate of 3.04%, and you'd need something like $1.295 million to make $40,000 a year. But here's the thing, dividend investing isn't a sprint, it's more like a long-distance race, and you can make good progress by doing two simple things. Firstly, you want to keep putting your money into buying stocks that pay dividends. That means every month you set aside some cash to buy more Coca-Cola shares. Let's say you start with 10 shares of Coca-Cola and keep buying 10 more shares every single month. Over 10 years, you'd be looking at an annual dividend income of $3,900, which isn't too shabby. But if you decide to up the ante and buy 20 shares each month instead of 10, you could expect a yearly dividend of $5,975. But there's one more thing that can help you grow your money even faster, and it's called compounding interest. Instead of pocketing your dividend cash, you put that money back into the same dividend-paying stock to make your money grow even quicker. They call this DRIP, or the Dividend Reinvestment Plan. So what does this DRIP thing do? Well, if you're buying 20 shares of Coca-Cola every month for a solid decade and reinvest your dividends, suddenly you're making an extra $1,000 each month without really doing anything. And don't forget, the value of your investments keeps going up, which means you might already have a pretty hefty nest egg that could be close to $500,000. In summary, dividend investing inspired by the wisdom of legendary investor Warren Buffett offers a practical path to financial growth and passive income. By carefully selecting dividend-paying stocks, ETFs or REITs, and employing a strategy of consistent investment and dividend reinvestment, individuals can steadily build wealth over time. While it may not yield instant riches, the patient and diligent pursuit of dividend income can pave the way to achieving long-term financial goals. That's it for today. Thank you for watching, and don't forget to click the like and subscribe button.